Hey mate, welcome back to Beyond Income. Listen, imagine you're sitting with me right now, cup of tea in hand, and I look at you and say, the Bank of England just dropped a bomb on all of us yesterday. You'd probably lean in and say, wait, what happened? Exactly. That's what we're talking about today. On 18th March 2026, the Bank of England's Monetary Policy Committee sat down, 9 members, and they all voted the same way, unanimously, to keep the bank rate at 3.75%. No cut, no hike, just hold. And the crazy part? Everyone in the market was expecting at least some chance of a cut because inflation was cooling down. But then the Iran situation blew up, oil prices shot past $100 again, and suddenly the whole game changed. Now, if you're in the UK with a mortgage, or you have savings, or even if you're in the US watching how global rates affect your investments, this decision is going to hit your wallet directly in 2026. So today, I'm going to explain everything in simple, straightforward language. No jargon, no complicated stuff, just like we're two mates chatting on the sofa. I'll tell you exactly what this rate hold really means for your monthly budget, your mortgage payments, your savings account, your investments, and what smart moves you should make right now before the next meeting in April. Stick with me till the end, because by the time we finish, you'll know exactly where you stand and what you need to do. Let's get into it.
Look, let me first tell you what actually happened, because most people just see the headline and move on. The Bank of England's job is to keep inflation around 2%. Last few months, inflation was coming down nicely. It was sitting around 3%. A lot of people, including me, thought they might cut the rate by 0.25% this time to help the economy. But then the Middle East situation got worse. Oil prices spiked hard because of disruptions in the Strait of Hormuz. Energy costs are going up again for everyone. Petrol, gas bills, electricity, even the price of almost everything we buy because transport costs more. So, the 9 members of the MPC looked at all this and said, you know what? Let's not cut rates right now. Let's keep them at 3.75% and watch carefully. And the vote was 9-0, completely unanimous. That doesn't happen very often. It shows they are really worried about inflation coming back stronger. Now, here's the big question everyone is asking me. Czar, what does this actually mean for me? Let's break it down one by one, like we're chatting properly. First, if you have a mortgage in the UK, most people on variable rate mortgages or those coming off fixed deals right now are feeling the pain. At 3.75%, your monthly payment is still quite high compared to 2 years ago. A lot of families are paying £200 to £400 extra every month than they were in 2023-24. If you're on a tracker mortgage, your rate is probably sitting around 4.5% to 5.5% right now, depending on your lender. That 3.75% base rate means your lender isn't going to drop your payments anytime soon. So, for the next few months at least, your budget is going to stay tight. If you're in the middle of remortgaging or your fixed deal is ending in 2026, this decision is actually good news in one way. It gives you more time to plan, but bad news because rates aren't falling as fast as we hoped.
Now, what about people in the US watching this? Even though this is the BoE decision, it affects you too. When the Bank of England holds rates, it puts pressure on the Federal Reserve as well. Global markets are connected. If UK rates stay higher, the dollar stays strong, and that can affect your investments, your 401k, and even the cost of borrowing in America. So don't think this is only a UK thing. Second big thing, your savings and fixed deposits. This is the part a lot of people miss. At 3.75% base rate, the best savings accounts and easy access accounts in the UK are still paying around 4% to 4.8% interest. That's actually not bad. If you have money sitting in a normal current account earning 0.5% or 1%, you are literally losing money to inflation every month.
So here's my straight advice. If you have emergency money or cash you don't need for the next 6 to 12 months, move it into a high-interest savings account or fixed-rate bond right now. Lock in 4.5% plus while you still can, because if inflation keeps rising because of oil, the real return on your money will disappear. Third, your investments and stock market. Higher interest rates for longer means borrowing is expensive for companies. That's why we saw some volatility in the market after the announcement. Tech stocks and growth companies usually suffer a bit when rates stay high. On the other hand, banks and energy companies tend to do better. If you have a pension or ISA invested in the stock market, don't panic and sell. This is actually a good time to review your portfolio. Maybe add a little more to defensive sectors, utilities, consumer staples, or even some energy stocks that benefit from higher oil prices. But the most important thing I want you to understand is this. The Bank of England is not being stubborn. They are being cautious because they don't want 2022-style inflation to come back. They said clearly in the minutes they are watching the Middle East situation very closely and they are ready to raise rates further if needed or cut them if the situation calms down. So what should you actually do in the next 30 days? Let me give you some real practical steps, the kind I would tell my own brother. Check your mortgage deal today. See when it ends. Start shopping around for the best fixed rate you can get. Even if it's slightly higher than you want, locking it in gives you peace of mind. Move your emergency fund to the highest interest savings account possible. Every 1% extra you earn is real money in your pocket. Review your monthly budget. With energy bills likely to rise again, cut 1 or 2 unnecessary subscriptions or eating out expenses for the next few months. If you invest, don't try to time the market. Keep putting a fixed amount every month, dollar cost averaging. It works in uncertain times like this. Keep some cash or gold as a small hedge, not everything in stocks. Look, I know this feels frustrating. A lot of us were hoping for rate cuts to make life a bit easier, but the truth is the world is unpredictable right now with the Iran situation and oil prices. The Bank of England is doing what they think is responsible. The good news? This decision is not forever. The next meeting is on 30th April 2026. If the Middle East situation improves and oil prices come down, we could still see a cut later this year. But until then, the smart move is to protect what you have and make small adjustments instead of hoping things will magically get better. Hey, before I finish, I just want to say one more thing. Moments like this, when rates stay higher for longer, are actually the times when smart people build real wealth. The ones who panic and do nothing lose out. The ones who stay calm, review their finances, and take small, smart steps come out stronger on the other side. So tell me in the comments, are you on a variable mortgage right now? Or are you more worried about your savings losing value to inflation? Drop it below. I read every single comment. If you found this useful, do me a solid favor, hit that like button and subscribe to Beyond Income. I'm making these videos every week to help normal people like you and me understand what's really going on with our money and how to protect it. Turn on the notification bell so you don't miss the next one. Thanks for sitting through this long chat with me today. I really appreciate you. Stay smart with your money, look after yourself, and I'll see you in the next video very soon. Take care, mate.